Financial statements and financial management, the most boring part of business. No, it's not. I'm going to talk to you about why financial management, managing the financing business can be so enjoyable. It can be incredibly motivational. I'm not going to say it's fun, but I'm also going to explain to you why it can be the simplest, quickest, easiest way to reduce stress in your business. What I'm going to do, I'm going to cover just 4 really simple, basic financial management techniques. They involve 4 different financial concepts. And at the end, I will actually mention how I think it can reduce stress massively. Possibly, in fact, most often, it's the best way to reduce stress in business. So the first one I want to talk about is the profit and loss statement, incredibly central concept. And the tip or the technique I want to give you for the profit and loss statement just relates to how you read it, how you interpret it. Yep, I'm going to take it as a given that you have a monthly profit and loss statement and that you actually look at it. If you don't do those things, then you've got further to go. But assuming you open it, a couple of simple tricks to make it useful, to make it worth doing, to make it worth the time. First of all, you have to compare your profit and loss statement to something. So when you get your monthly profit and loss statement, last month you made a profit of $50,000. Is that good? Is that bad? Well, it might be good, might be bad. It depends. What were you expecting? What was it last year at the same time? That's the context you have to have. And not just for the bottom line. When you work through it, through the items in the P&L, compare them with something. Now, for a lot of businesses, they actually compare it with 2 things. They compare it with the same month last year. That's good. How are you going? Are you growing? Are you saving costs? Are you improving the business? And they compare it with the budget they set for themselves over the year. So when they set that budget, they had plans and they said, all right, we're going to implement these things, execute on these plans, and we believe it'll produce this amount of money, this budgetary outcome, this revenue and these costs. And that's worth a certain investment. Now, it's good to keep a track over the course of the year. Are you actually achieving what you expected and what you budgeted? So look at your P&L compared to something and also just focus on the big numbers. Skim your eyes down and only focus on numbers that are material. If you're an accountant or an auditor, you'd go through every line item. But as a business owner, you've got to focus on the things that matter, the things that make a difference. So when you're looking down and you're comparing actual with budget, item by item by item, just stop. And inevitably, there'll only be probably a dozen material items, if that, for a lot of small businesses. Focus on those, the ones that are going to make the difference. That makes it simple, and it means very quickly you'll be able to actually pick up the story. The P&L tells you the story of the operation of your business. Second one I want to talk about is your break-even point. Now, break-even point is just that measure of sales, and I'm going to say each month. You can do this daily. You can do it weekly, quarterly. I'm going to focus on monthly. Depends on how frequent transactions are in your business. If you have a business where there's lots and lots of transactions going through very quickly, then daily break-even is fine. But let's talk about monthly. Break-even starts with knowing what is that level of sales at which your revenue, and more to the point, your gross profit, will cover all of your expenses. You'll break even. Before that, before you've reached that sales level, that number of units, you need to sell 1,000 units. You need to pick up 20 customers, whatever it is. Before that, you're losing money because you've got a bunch of fixed costs in your business you can't avoid. Once you hit that break-even point, anything above that now is gold because all your fixed costs are paid for. So now all of the gross profit above that level of sales goes straight to the bottom line. So it's highly profitable. It's a very exciting moment. And to me, it starts with knowing what is that level, monitoring it, tracking it, probably your team knowing it, planning how do you get to it, counting down to it if you like, and absolutely celebrating when you get there. Because you know at that point you've covered all your costs for the month or week or day, whichever you're using, and now it's all getting very profitable from there. It's very easy to calculate, by the way. It's just, you can, if you divide your, for example, divide your fixed costs, your total fixed costs, by your gross margin, your gross profit margin. That will tell you what your break-even level is. So find out what it is and then actually work to it. Plan to it and work to it. And it's quite motivating. It's quite exciting. You know where you are. You see where you are. And you also know when you've got to that great point. Third one I want to mention is your cash gap. Cash gap is simply the difference in time. This is a time concept, it's not dollars. The difference in time for a certain amount of work, certain piece of work, the difference in time between when you pay out money and when you receive money for that work. So for example, a construction company is quite an extreme example. They will have to pay out usually quite a lot of money before they receive all the money. They'll have to pay their subcontractors. They'll have to pay to order the raw materials, the bricks and the concrete and the timber and so on. And then they eventually get paid after they complete the job. Now they'll have probably some payments along the way, but broadly speaking, they have to pay out quite a lot before they receive all the money. And that's very common in a lot of businesses. And the period of time for a certain piece of work, between when you pay out money and when you receive it, what are you being at that point? That's right, you're being a bank. You're offering credit. And for most of us, we don't have a balance sheet to be a bank. So you want to reduce that period of time as much as possible. Now, I would absolutely never recommend that any business, for example, pays late. But don't pay early. When you've received an invoice, make sure it's paid the day it's due or the day before it's due. When you're issuing invoices, if you're a business that issues invoices, issue them as early as possible and use a number of tactics and strategies to get payment early. Perhaps issue them early in the context of, dear customer, this is the invoice we'll be issuing you. We welcome payment as soon as possible. Follow up payments as quickly as possible. Think about whether you should have things like payment penalties if people pay late. Should you ask for down payments, prepayments, deposits? The range of things you can do is not infinite, but there's a lot you can do to get paid earlier. Sometimes even not just paying as late as possible, not as late as possible, but as late within terms as possible. You can also renegotiate with suppliers, see if you can get better terms. There's a lot you can do to optimize your cash gap. And every day, literally every day, you're not being a bank is a day you're either not paying out interest on credit card or loans or whatever it is that you're funding that with, or it's another day you can make money out of that money. Now, at the moment, putting it in a bank's not a great place to make money, but you might be able to invest it in other activities in your business. There are lots of ways of optimizing it. The last thing I want to talk about is the cash flow forecast, because this to me is the biggest stress reducer in business. Cash flow forecast is simply that document which shows you, and you should have this every week. There are really no exceptions to this in any business. Every week you get an updated cash flow forecast. If things are really tight, you might need it daily, but at minimum, get it weekly. And what it does, it shows on the front page, it shows starting balance for each week for the next 3 months. Must go 3 months out, because in Australia, at some point you're going to have things like BAS, wages, the big items, and you never want to be surprised by those. So you have starting balance. Now, on the other 2 pages, you've got a page where it's all the inflows, week by week, item by item. It might be customer by customer or product line by service line, geography, but it's item by item, week by week. What do you think will come in? And likewise, in the outflows, the different expense line, wages, rent, tax, anything that cash goes out for. Item by item, week by week, when do you think it'll go out? Now, the spreadsheet you set up should just do this automatically. It'll transfer the inflows and the outflows to the front page, and you can see week by week, inflows, outflows, and therefore balance at the end of the week. So you can, and it'll come up with a little chart that'll show you this is where we're sitting here today for the next 3 months. This is what you think the cash balance in your business account is going to look like. Now, it's fantastic. It means you can celebrate when you see it going up and up and up. If you see it getting too tight, if you see it getting below your minimum buffer, whatever that is that you've set, or heaven forbid getting down towards zero, at least now you're going to see it 3 months out. You've got time to do something. Bring forward a sale. Go out there and run a campaign, get some more customers. Maybe hold off on an expense. You know what's happening. You can see exactly where you are, not just now. It's not just a case of waking up and looking at your bank account thinking, oh no, there's no money there. It's seeing it in advance. It's incredibly straightforward. It'll take you a couple of hours to set up the first one, probably the first couple. But by about week 3, week 4, it takes less than half an hour to update each week because it's really just shifting things, having a quick look and thinking, has anything changed since last week? Looking out a week further. Have we picked up some new business? Have we added an expense? Have we reduced an expense? Who knows? So just updating it, it's a very quick exercise, but it means you always know from a cash perspective, not just where you are now, but where you are likely to be over the next 3 months. Not where you know you'll be, it's future, but it's where you're likely to be based on everything you know now. And to me, that is, on the one hand, quite motivating and sometimes exciting. It's greatly comforting though. It means I'm in control. It means I know where things are. And so much of stress in business relates to money, and it relates to some version of what if, what might happen? Oh God, what if I wake up and there's no money in the bank? Remove that. Get control and know what's happening. Know what the cash situation is for 3 months in advance. And I promise you, your stress will be reduced significantly. All the best.